liquidity is everything. All of my forward-looking indicators have been suggesting that liquidity is going to keep rising and that it would drive crypto and tech more than anything else. And that's basically been the story of the year so far. And I think that continues. And that's confused a lot of people. The one trade that's confused me is the bond trade, and that's confused a lot of people. Bond yields should have fallen by now, and they still haven't. But I think this is to do with the debt ceiling issue, which is the other confusing thing. Because the debt ceiling issue has some real risks around it, and we don't really know how to price them. All we do know is people are pretty bearish around it. And I think that's reasonable too, to have hedged around it, because we don't know what can happen. But the chances are that anything that causes a paralysis of financial markets will lead to that expression I always use, more cowbell, more stimulus to come.
Bitcoin has been trying to break above the $27,500 resistance for the past week, but to no avail. One of the reasons limiting Bitcoin's the upside is the risk of an eventual United States default as the government struggles to get the debt limit increase approved in Congress. Still, some analysts and investors argue that the U.S. debt ceiling standoff is merely a show because ultimately, additional money will hit the markets. Hello and welcome to Money Talks. In today's video, Raoul shares his analysis of the macro view. Also, he talks his prediction about Bitcoin, gold, and the debt ceiling.
Millions of prices suggest that US CPI as of today is 3.2%. I think it still goes to zero by June or July, which Alex Gurevich has been talking about both on Real Vision and also on Twitter as well. We're very in a small camp of that. We're also seeing wage growth coming down. We're seeing rents and wages are the most lagging of all. So they're all still to come down. So generally speaking, economy's slowing. We've got this whole debt ceiling stuff that's getting people very nervous. The resolution of that one way or the other ends up being ongoing liquidity as the economy slows. The banking issues have slowed down for the time being, but doesn't mean it's gone away. These things tend to come in phases. And so technology and crypto tend to outperform. Crypto's been consolidating for a while, but it's still up 50-60% on the year, still the best performing asset. But again, it's likely to pick up as liquidity comes forward, as shown by our forward-looking liquidity indicators. And we've probably got 20 or 30 different things we could show you to say the liquidity is going up. So yeah. I remain massively bullish. There will be a correction at some point in all of this. As people start throwing in the towel in the short positions, then we might get a correction before we continue to move higher later on in the summer. So overall, super bullish. The only one that's puzzling me is the bond market still hasn't played ball, but I think we need to get through this debt ceiling thing, and then a lot of hedges get unwound.
Notice how MacroJack correlates Bitcoin's digital scarcity to the next logical step: additional inflationary pressure. The stimulus measures, meaning increasing the government debt limit, might initially sound positive because they avoid default and favor more economic activity. However, the unintended consequences are future budget constraints as the debt interest payment increases. Margin markets provide insight into how professional traders are positioned because they allow investors to borrow cryptocurrency to leverage their positions. OKX, for instance, provides a margin lending indicator based on the stablecoin BTC ratio. Traders can increase their exposure by borrowing stablecoins to buy Bitcoin. On the other hand, Bitcoin borrowers can only bet on the decline of a cryptocurrency's price. This chart shows that OKX traders' margin lending ratio increased between May 12th and May 17th. Such data coincides with Bitcoin's price recovery in the period, although it is not troublesome, as the current 31 margin lending ratio nears its 30-day average.
This 50% correction in equities can't happen because simply they just expand the balance sheet and the denominator takes care of the fall and they rise. So it just simply can't happen. The only way that it could happen is if we see massive quantitative tightening. But then the economy goes down the toilet and they've got the unemployment side of the equation, the inflation side. So it just can't happen right now. Now, that's not mean this will stay forever, but it's a situation that quantitative easing is used as a way to pay the debts, and particularly the interest payments on the government debt. And that was, again, part of this everything code, that everybody reset their interest rates to zero in 2009. Everybody, every country. It was like a global reset. I only realized it recently that that was the global reset. And so everybody's now in this debt cycle of every 3 to 5 years of having to roll the debt. The interest payments get monetized, and that is the increase in the balance sheets. It almost exactly works out for the US, the UK, Japan, Europe, etc. They're all just the monetization of the interest payments.
As Cointelegraph reported, shorter-term and longer-term downside targets currently extend to around $25,000 and $24,000, respectively. Zooming out, meanwhile, fellow trader Credible Crypto revealed a belief that a more pronounced return to the upside could come within the next month. How much longer till expansion, and is the bottom in? 25Ks tested, lick below us taken. Bottom for this correction might be in, but need to see how PA develops over the coming days. While we can't rule out a flush lower yet, developing PA will give us some clues to work with, part of a tweet on the day explained.
I think inflation, headline CPI, gets to zero or even negative by the summer. It then picks up again. And what we will then see is the slow effects of owner's equivalent rents, services inflation, which is mainly owner's equivalent rents, and wages. That usually lags on for 18 months. So that keeps inflation low coming out of a recession. And I think the AI thing, as I've talked about, is a deflationary nuclear bomb in all of this. So I think the probability is that unemployment is sticky coming out of this, stickier than expected, and inflation is not as rampant. So even if commodity prices, and I understand there's some tightness in commodity markets, but everybody's tried to take that trade has been taken out and shot right now by the markets. And Dwight Anderson warned us about this on Real Vision. He's like, yeah, they're tight, but there's no demand. And if you keep looking at the supply side of the equation, you'll get carried out because the demand equation will kill it. He said, the next time we come into the upside of the business cycle, we are going to get some commodity inflation, but that can be easily offset by deflation of AI, much like we saw in the mid-2000s with China coming in. They caused a massive spike in commodity prices, but inflation was relatively sanguine because of the effect of China in the WTO when the goods were coming out cheaper, globalization. This side, we've got AI, which is hugely disruptive, balancing against the commodity inflation that can come. So I think inflation is slower than the market expects.
So, what are your thoughts? Is it a good time to buy Bitcoin? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.